Hello, and welcome to Lesson 1, Income Tax Fundamentals. By the end of this session, students should be able to understand filing status, understand gross income, identify major adjustments to gross income, identify who is considered a dependent, describe the meanings of income tax and liability, describe payment of taxes, describe accounting methods, and identify tax reduction techniques. As a financial planner, you'll be asked to review various documents to understand your client's tax situation, financial situation, and make recommendations. One of the most common documents you'll be asked to review is a client's tax return. So today we're going to go over the fundamentals of the income tax calculation and the calculation mechanics. Today we'll discuss the tools that will allow you to analyze a client's tax return and obtain the data you need to inform the financial plan. Now here we see some key terms in the income tax formula. We'll talk about these terms in detail in the coming slide, but let's take a minute to go over the income tax formula. That formula is gross income minus adjustments for gross income equals adjusted gross income. Then from adjusted gross income, we subtract the greater of a standard deduction or itemized deductions. And for pass-through business owners, we subtract qualified business income. And that brings us to taxable income. We apply the marginal tax rates to taxable income to arrive at total tax liability, and then we subtract credits and any payments made and come up with a balance due or an overpayment for the clients. Now let's take a look at the individual items in that formula in a little bit more detail. Gross income for tax purposes includes all income from whatever source derived unless specifically excluded. If money has been obtained illegally, say by extortion, it still must be included in gross income. Gross business income must also be reported. If a client has a Schedule C business, meaning the client is a sole proprietor or a single member of an LLC, gross income is reported on a separate schedule where business expenses are also deducted, and the net business income is reported on page 1 of the Form 1040. It's important to note that all taxpayers must file a tax return if their income exceeds a certain threshold, and that threshold is dependent mainly upon the filing status and the taxpayer's age. Income that is not included in gross income is called excluded income. Examples of exclusions are most life insurance proceeds, gifts, inheritances, interest from municipal bonds, employee fringe benefits, the cost element of annuities, child support payments, welfare payments, and some workers' compensation benefits. Although the general rule is exclusion status for the above items, there are exceptions to the general rule of exclusions, such as the purchase of life insurance policy from someone else, not from an insurance company, a donor not paying gift tax, and alternative minimum tax items. So due diligence is required. Research before excluding an item from gross income. Now here are some items of gross income that are reportable. You can see we have compensation, interest and dividends, alimony received, gross income from self-employment, gains from sale of assets, distribution from retirement plans, rental income, unemployment compensation, and royalty income. It's important to note that although these items are certainly part of gross income, this is not an exhaustive list. Now, after we report all of our gross income that is not excluded for tax purposes, we want to take a look at deductions for AGI, deductions for adjusted gross income. These are also known as above-the-line deductions. These items include alimony paid in some cases, retirement plan contributions, certain tuition or higher education expenses, and interest paid on student loans. Those are the most common deductions, but you can refer to the IRS Schedule 1 for additional deductions available. Once we've subtracted our deductions for AGI, we arrive at adjusted gross income. The adjusted gross income is an individual concept only. It does not apply to businesses. AGI is important because it's used to determine a lot of things. It's used to determine certain deductions and certain credits and whether they're allowable or whether they're phased out. Medical expenses are limited to the amount above 7.5% of AGI. Some credits are limited by AGI, and even the ability to make a Roth IRA contribution or make a deductible traditional IRA contribution is partially based on this AGI number. So when we look at subsequent weeks, when we learn about tax planning techniques, you will learn why a deduction for AGI, something that reduces that AGI number, is going to be much more valuable than a deduction from AGI, also known as a below-the-line deduction, which is what we'll talk about next. From AGI, adjusted gross income, the taxpayer has the ability to subtract the higher of the standard deduction or itemized deductions. So let's take a look at what the standard deduction is. It's a statutory number, it's indexed for inflation, and it's based on your filing status. A single person has a different deduction than a married couple filing jointly, which is different from the head of household, which is different from a dependent child. In addition to whatever that base standard deduction amount is in a given year, an additional standard deduction is available for those who are 65 or older or blind. So it's possible for a married couple who are both over 65 to have a standard deduction for a married filing joint couple plus 2 additional age-related exemptions. Now, once we've computed the standard deduction for a taxpayer, which changes every year, so refer to your textbook for the current year numbers, we compare it to the taxpayer's itemized deductions for the year. A taxpayer's itemized deductions is the sum of applicable deductions from this list, and if the itemized deduction total is greater than the standard deduction total, we take the itemized deductions. If the standard deduction total is higher, then we take the standard. Now let's take a look at the itemized deductions that we have listed here. Itemized deductions are pretty complicated. There are nuances, limitations, and exceptions. We will spend a lot more time on itemized deductions in coming weeks, but in order to help you understand just the flow of the tax formula, we'll cover them here briefly. Itemized deductions include medical expenses in excess of 7.5% of AGI, state and local income taxes or sales taxes, one or the other but not both, real estate taxes, personal property taxes, interest on home mortgages, investment interest, charitable contributions, and certain casualty losses from presidentially declared disaster areas, and those losses must be in excess of 10% of AGI. So here we see the AGI concept appearing again. It's important to note that there are limits on the maximum allowable deductions for taxes, interest, and contributions, and we'll cover those limits in future weeks. Qualified Business Income, or QBI, is a new deduction created by the Tax Cuts and Jobs Act of 2017. The Act reduced corporate income tax rates, and the QBI deduction is an attempt to give owners of pass-through entities, such as sole proprietorships, similar tax relief. This deduction can be up to 20% of qualified business income, but there are income limitations and limitations on the types of businesses that qualify for this deduction. We will cover this deduction in more detail in a future lesson. So after deducting the QBI, we arrive at taxable income. We apply our marginal rates to determine tax liability and subtract the payments to arrive at the balance due, or hopefully an overpayment. This lesson, we reviewed the basic concepts of the tax formula. In the next lesson, we will discuss some of these fundamental concepts in more detail.